There's an incredible buzz when you first hit upon a new business idea, isn't there? That passionate surge to bring your creative vision to life, to build something from the ground up. It's exhilarating.
Mm.
But here's the thing we see far too often. That initial excitement can sometimes lead entrepreneurs to jump headfirst into their venture without fully grasping the foundational financial and legal
Yeah.
aspects. Our source material for this deep dive, a really comprehensive UK startup handbook on bookkeeping and accounting, it kicks off with a stark warning about how this can lead to incredibly costly mistakes and, missed opportunities down the line.
And that warning isn't just theory. What's truly fascinating and a real aha moment for many clients is when they realize this vital information too late.
Right.
We often hear from businesses, maybe in their second or third year, lamenting that if they'd only known all of this from the outset, it would have, and I quote, dramatically changed their business approach.
Wow.
So this deep dive is designed to be your shortcut to that very awareness, arming you with insights now so you hopefully don't have those regrets later.
Exactly. Our mission today is to unpack the essential nuggets from this handbook, giving you, our listener, the tools to confidently choose the options that best fit your unique situation and truly give your business the best chance to, well, thrive. Okay, let's unpack this. The very first and arguably most critical decision for any aspiring entrepreneur once that brilliant idea sparks is choosing the right business structure. And here's where it gets really interesting, because this isn't just about picking a name. It fundamentally sets the stage for your entire venture. You've got the main options: sole trader, partnership, limited company, and the somewhat more specialized limited liability partnership, or LLP.
And what's fascinating here is why this choice is so fundamental. It's not just a box to tick,
Right.
It defines your legal responsibilities, from the paperwork you need to file to who's accountable for what. Crucially, it dictates the taxes you'll manage and pay, how you can personally take profit from the business, and perhaps most importantly, your personal liability if the business happens to make a loss. Think of it as choosing the very foundation of your business house.
That paints a really clear picture. So let's talk about those foundations. If
Yeah.
you go the sole trader route, it's undeniably the simplest to set up and get going.
Definitely.
You're in full control. The financial reporting is minimal. It's often the natural first step for freelancers or, single person operations. But what's the biggest trade-off here?
The biggest trade-off for a sole trader is the unlimited personal liability for debt.
Ah,
This means your personal assets like your home or your savings aren't separate from the business's liabilities. If the business gets into financial trouble, you're personally on the hook.
No.
It's easy to get started, yes, but it carries a significant personal risk.
Yeah.
You also need to register with HMRC for self-assessment and file an annual tax return, paying income tax on your profits and national insurance contributions. This setup generally suits those with lower startup costs and minimal risk, or maybe those just testing the waters.
got it. So simple to start, but definitely be mindful of that personal risk. What about the partnership? It seems like a natural step up if you're joining forces with someone.
A partnership is, well, essentially a sole trader arrangement,
Mm-hmm.
but with multiple individuals. It can make it easier to raise finance because you have more people contributing, maybe pooling skills and resources.
Sure.
However, the downsides tend to affect all partners equally, that shared liability we just discussed.
Yeah.
It applies to everyone, and it can be notoriously messy to wind up if things go south or, partners disagree. You're still personally liable, but now you're also potentially liable for your partner's actions too.
That definitely sounds like something you'd want a clear agreement on beforehand.
Absolutely. A partnership agreement is vital.
Then we have the limited company. This one always feels like a bit of a bigger step for small businesses. What are the key advantages and where does the extra complexity come in?
Well, the limited company is where you get that crucial separation.
Right.
Your personal financial exposure is limited by the shares you own, meaning your personal assets are typically protected if the company runs into trouble. It also often offers a, let's say, more favorable tax regime, particularly as profits grow, and it can lend your business more credibility, especially when dealing with larger corporate clients.
Okay, that makes sense.
However, you're right, it does come with significantly more administrative and regulatory demands. There's more paperwork, more annual accounts to file with Companies House, and a lot more information becomes publicly available. It's a professional step up, but it definitely demands more disciplined administration.
So less personal risk, but more red tape, basically.
That's a good way to put it, yeah.
And finally, the limited liability partnership, LLP. This sounds like a hybrid. Who is this typically for?
The LLP is quite flexible, often used by professional firms like, say, accountants or lawyers. It combines the limited liability protection of a company with the operational flexibility of a partnership.
Okay.
However, profits are still taxed as income for each partner, rather than the company paying corporation tax first, and partners still have to disclose their income. It's a good choice for specific collaborative ventures where you want that limited liability without the full corporate structure for taxation purposes.
That's a lot to consider right off the bat. If you're listening, what stands out to you when considering these critical distinctions? For me, it's really about understanding where your personal risk truly lies.
Exactly. The choice isn't one size fits all. It really depends on your risk appetite, the nature of your business, your growth ambitions. It's about picking the right shoes for the journey you're about to embark on.
Speaking of journeys, once your business is set up, there's an ongoing relationship with the authorities, particularly Companies House. Think of it as your company's annual report card.
That's a great analogy. Companies House primarily has two main annual filing requirements. The confirmation statement, which used to be known as the annual return, and the
Oh,
statutory accounts.
yeah.
The confirmation statement is essentially a yearly snapshot of your company's core information. It's due within 14 days of either the company's incorporation anniversary or the made-up date of your last return.
Right.
It confirms key details like your registered office address, the type of business you run, the names and addresses of all directors, and who owns what shares. It's a quick, factual update. Filing it online is $34, a bit more if you still do by paper, which is $62.
Okay, so that's the who's who and what's what of your company. Pretty straightforward. But what about the actual financial performance? What does it mean if you're a small company and need to file statutory accounts?
Right, so for small companies, you have a few scaled options depending on your size, designed to reduce the administrative burden a bit. If you're a really tiny business, you might qualify for microentity accounts. You need to meet at least two of these three criteria. Turnover no more than £1 million, balance sheet total no more than £500,000, or an average of no more than 10 employees.
Okay, very small then.
Exactly. Slightly larger small companies can file abridged accounts if they meet two of three criteria. Turnover up to £15 million, balance sheet total up to $7.5 million, or up to 50 employees. This offers a bit more detail than microentity accounts, but is still simpler than full accounts.
I've got it.
Then there are full accounts, which are for what are called audit-exempt small companies, meaning you don't need an external auditor checking your books, which is a significant saving for many businesses.
Right.
And finally, dormant company accounts are for companies that have never actually traded, so that's a much simpler filing process.
That's helpful, simplifying based on size. But what happens if you miss these deadlines? Because I imagine, like many things, there are consequences.
Oh, absolutely. Companies House automatically imposes late filing penalties for company accounts, and they apply to all companies, regardless of whether they're trading or not.
Wow, okay.
For a private company, being up to 1 month late incurs a £150 penalty, and this escalates quite steeply. If you're more than 6 months late, that penalty shoots up to £1,500.
1,500. Ouch.
Yeah, it's an automatic system, so there's really no escaping it,
Right.
and it adds up fast.
Right, so staying on top of those companies' house dates is absolutely crucial. Now let's shift focus a bit to your payroll responsibilities if your business grows and you start bringing on employees. We're talking about PAYE or pay as you earn, which is HMRC's system for collecting income tax and national insurance from your team members.
Exactly. As an employer, your primary role is to deduct income tax and national insurance from your employees' gross pay. You'll also likely pay employers' Class 1 national insurance contributions, if applicable. You must provide payslips showing the gross pay, all the deductions, and the net pay. And critically, on or before each payday, you must submit a full payment submission, or FPS, online to HMRC, detailing payments to all your employees.
Every payday.
Every payday. And payments for both payee and national insurance are then due to HMRC by the 22nd of the following month. It's a very tightly controlled system, so accuracy and timeliness are, well, paramount.
So beyond just basic salary, what else counts as pay for payee purposes? It sounds like there's a broader definition at play here.
There definitely is. It includes things like, obviously, wages, overtime, holiday pay, and bonuses. But it also covers certain cash expenses, statutory payments like sick pay, maternity, paternity, or adoption pay,
Right.
and even some non-cash items, for instance, certain vouchers provided to employees. Essentially, most forms of employee compensation will fall under the payee system.
And just to quickly touch on it, how do those UK tax rates look for 2025-26? I know it's a progressive system.
That's right, it's progressive. For 2025-26, the personal allowance, the amount you can earn tax-free, is £12,570 per year.
Okay.
After that, you hit the basic rate of 20% on earnings, up to £37,700. Then comes the higher rate of 40% on earnings, from £37,701 up to £125,140.
Right.
And for anything earned above £125,140, the additional rate is 45%. It's a tiered system, so different portions of your income get taxed at different rates.
Okay, let's move on to VAT, value-added tax, which for many can feel like a whole different beast.
It often does.
It's a tax charged on most goods and services in the UK.
It is, and understanding it is really key. There are three main rates of VAT. The standard rate is 20%, applicable to the majority of goods and services.
Okay.
The reduced rate is 5%, which applies to things like domestic fuel and children's car seats. And then there's the zero rate, which is 0% on items such as most food, books, children's clothes, and public transport.
Yeah.
Now, it's also important to note that some categories are entirely exempt from VA, or even outside the UK VAT system. For example, insurance, education, and many medical services are exempt.
Okay, what's the difference there? Exempt versus outside.
Good question. The key difference is that with exempt supplies, you don't charge VAT on your sales, but you also cannot reclaim VAT on related purchases. Things outside the scope aren't considered a supply for VAT at all, like statutory fees.
That clarification on exempt versus outside the scope is really helpful. So when does a business have to get tangled up with VAT registration? Is there a trigger point?
Yes, there is a mandatory trigger. You must register for VA if your taxable turnover for the previous 12 months has gone over £90,000.
90,000, okay.
Or if you expect it to do so in the next 30 days alone. However, you also have the option to register voluntarily, even if you don't meet that threshold.
Why would you do that?
Well, it can be beneficial if your customers are mostly V-registered businesses themselves, and you incur significant VE on your own purchases, as it allows you to reclaim that input VAT. It depends on your circumstances.
That makes sense. Are there any schemes that can simplify the V8 process, especially for smaller businesses, maybe make it less daunting?
Absolutely. HMRC knows it can be complex. There are two key V8 accounting schemes that can simplify things considerably. The cash accounting scheme means you only pay V8 to HMRC when your customer has actually paid you.
Ah, good for cash flow.
Exactly.
Yeah.
And similarly, you can only reclaim V8 on purchases once you've paid for them. It can be incredibly beneficial for cash flow and for managing bad debts. You can join this if your turnover is $1.35 million or less.
Okay. And the other one?
Then there's the flat rate scheme, which is designed to really reduce the time you spend accounting for VA. Instead of calculating VA on every single transaction, you pay a fixed, usually lower percentage of your total turnover as VA.
How does that work?
Well, it makes record keeping much easier, saves a lot of time. The key trade-off here is that you generally cannot reclaim VAT on your purchases, although there are some exceptions for capital assets over £2,000.
Right.
You do get a 1% discount in your first year of being VAT registered, though. You can join this scheme if your turnover is £150,000 or less, excluding VAT. It simplifies things, but you need to check if the no-input VAT reclaim works for your specific business model.
If we connect this to the bigger picture of compliance, what are the real consequences of late VAT submissions or payments? Because it seems like HMRC doesn't mess around here either.
You certainly don't. The deadlines are quite strict. Your V8 return submission and payment are generally due electronically by the 7th day of the second month after the end of your accounting quarter.
Okay.
If you're late, HMRC records a default, and you may enter a 12-month surcharge period. If you default again within that period, the surcharge period extends, and you could face an increasing surcharge percentage of your unpaid VAT.
So it ramps up.
It does. For example, your first default might not incur a surcharge, but subsequent ones can quickly lead to penalties of 2% or more of the VAT due, rising with each default. Beyond surcharges, penalties for inaccuracies can be up to 100% of any tax understated.
Wow.
And there's even a £400 penalty if you submit a paper VAT return when you're supposed to file online, unless you have an exemption. It's a clear incentive to be organized and on time.
Definitely. Okay, for those of you running a limited company, let's zero in on corporation tax. This is the tax that applies specifically to the taxable profits of limited companies and some other organizations too.
That's right. When we talk about taxable profits for corporation tax, we're looking at a few key areas. Your trading profits, that's money your business makes from its core activities.
Sure.
We also look at investment profits, though dividend income received from other UK companies is generally treated differently. And capital gains, which are referred to as chargeable gains for corporation tax purposes. Essentially, it's the tax on the company's overall financial success.
And what are the corporation tax rates looking like for 2025-26? I know there was a fairly recent change there.
Yes, there was a significant change. For the 2025-26 period, the main corporation tax rate is 25%. That applies to companies with profits over £250,000.
Okay.
However, if your profits are £50,000 or less, you benefit from a small profits rate of 19%.
19%. Okay.
And for companies with profits between £50,000 and £250,000, there's a system of marginal relief. This basically means your effective tax rate gradually increases as your profits grow within that band. It prevents a sudden, harsh jump from 19% straight to 25% for every pound over £50,000. It's designed to smooth the transition.
That marginal relief sounds like a really important detail to understand. And here's a crucial distinction with corporation tax that often catches people out. Payment is typically due before filing the return, right?
That's absolutely right, and it's a big one. Generally, you must pay your corporation tax by 9 months and 1 day after the end of your company's accounting period.
9 months and 1 day.
Correct. The company tax return itself, known as the CT 600, then needs to be filed by 12 months after that same accounting period end. So, for example, if your financial year runs from April 1st, 2023 to March 31st, 2024,
Yep.
you'd need to pay your corporation tax by January 1st, 2025, and then file your actual CT 600 return by March 31st, 2025. It means you need to be forecasting your profits accurately well in advance to make sure you have the funds ready for that payment deadline.
And what about the penalties if you miss those corporation tax deadlines? Similar story.
Very similar, yes. If you miss the payment deadline, interest charges will accrue immediately on the unpaid tax. For late filing of the return, it's £100 for just 1 day late and another £100 if you're still late at 3 months.
Okay.
At 6 months late, HMRC will estimate your tax bill if you haven't filed and add a penalty of 10% of any unpaid tax shown on the return when it's eventually filed. There's another 10% added at 12 months late. And it gets particularly painful if you're late filing 3 times in a row, as those initial £100 penalties jump significantly to £500 each. It's a clear message. HMRC takes these deadlines very seriously indeed.
We've talked a lot about the big picture stuff, the structures, the compliance, but let's shift to the practical day-to-day. Maintaining good financial records, bookkeeping. Why is this so essential beyond just ticking boxes for tax compliance?
Oh, good bookkeeping is absolutely critical for multiple reasons. Firstly, and perhaps most importantly, for you as the business owner or manager.
Right.
It tells you your real-time profit or loss, what your liabilities are, who owes you money, your debtors, and the balance of your business assets. Without it, you're essentially flying blind, unable to make informed decisions about pricing, spending, investment.
Yeah, makes sense.
Secondly, of course, for the tax authorities, HMRC, they need to see your records to confirm you're paying the right amounts of taxes, VAT, PYE, corporation tax, whatever applies. And thirdly, for other stakeholders, think shareholders, potential investors, maybe the bank if you need a loan. They will all want to see these financial records to assess the business's health and make decisions about supporting you. It's your business's financial GPS, really.
That's a great analogy. So what are the basic components of any effective bookkeeping system, whether you're going old school with a spreadsheet or using some fancy cloud software? What modules should you be looking for?
Good question. At its core, you'll need a bank module to track all your bank transactions and ensure your running balance matches your actual bank statement. Reconciliation is key.
Okay.
Then, a supplier's module, sometimes called accounts payable, to keep contact details and track the bills you need to pay and record when you've paid them.
Right.
Conversely, a customer module, or accounts receivable, does the same for your sales invoices, tracking who owes you what and when payments are received. The general or nominal ledger is kind of the engine room, the central collection of all your business accounts, summarizing everything. And finally, crucially, a reporting function that allows you to generate essential insights like profit and loss statements, balance sheets, maybe cash flow forecasts, and of course your VAT returns if you're registered.
And luckily, for many small and growing businesses, there are loads of popular cloud-based accounting software options available today that automate much of this, right? Things like QuickBooks, Xero, FreeAgent, QuickBooks, Sage.
Exactly. They really take a lot of the manual grunt work out of it.
They must save so much time.
They absolutely do. They often integrate directly with bank feeds, which pulls in your transactions automatically and can automate many of the reconciliation processes, saving significant time and reducing errors compared to manual systems.
This raises a really practical question for business owners looking at their spending day to day. When you're looking at your expenses, how do you know what's allowable versus disallowable for tax purposes? It feels like a common trip-up point.
It absolutely is, and the core principle HMRC uses is key. Any expense incurred wholly and exclusively for the purpose of the business is generally tax deductible or allowable.
Wholly and exclusively.
Okay, that's the magic phrase.
Uh-huh.
Common allowable expenses include things like office costs stationery, phone bills, postage, travel costs directly for business purposes, train fares to meet a client, for example, specific clothing expenses such as mandatory uniforms or essential safety gear.
But not just a suit for the office.
Exactly. Not just a suit for the office that's considered dual purpose, personal and business, so it's out. Staff costs, including salaries and pensions, the cost of goods you buy to sell on your stock, financial costs like business insurance or bank charges, business premises costs, rent, rates, utilities, and advertising or marketing costs. If you can directly link it to generating income for the business, it's usually allowable.
So that wholly and exclusively rule is paramount. What about the flip side? What are some common expenses that people think they can claim, but HMRC will say no to? The disallowable ones.
Right? That's where the disallowable list comes in, and it's important to get your head around this. These include things like asset depreciation. You can't claim the accounting depreciation itself, but you can usually claim capital allowances on the purchase of qualifying assets, which is HMRC's equivalent.
Okay, different mechanism.
Different mechanism, yeah. Dividends paid to shareholders are also disallowable expenses, as they are a distribution of profit after tax, not a cost of earning it. Client entertainment is a big one. Taking clients out for dinner or drinks is generally disallowable for tax relief.
Ah, okay.
Gifts to clients, unless they're very small promotional items under about £50 and carry clear advertising for your business. Donations to unregistered charities, fines and penalties, parking tickets, HMRC penalties, definitely not claimable.
Makes sense.
And personal travel costs, like your daily commute to and from your home and your usual place of business, that's considered private travel. And generally, meals are disallowable unless you're on a specific business trip away from your normal base, incurring extra subsistence costs. The crucial distinction to always keep in mind is separating private use from business use. If it has a personal benefit element, it's likely disallowable or needs apportioning.
What a journey we've taken today. Seriously, from the very first steps of choosing a business structure, navigating the nuances of sole trader versus limited company, to understanding the ongoing compliance with Companies House and HMRC for payee, VAT, and corporation tax, and finally grasping the critical importance of a robust bookkeeping system and what you can and can't claim. This knowledge isn't just about avoiding fines, it's truly about empowering you as an entrepreneur.
Absolutely. I think the core value here is that knowledge is most valuable when it's understood and crucially applied. Don't defer these vital concepts to someday or just hand them off entirely without understanding the basics yourself. Actively engage with them now to set your business on the strongest possible foundation. It gives you clarity and control from day one, which is invaluable.
So as you go forward from this deep dive, imagine what you could achieve by proactively building on this knowledge now, rather than looking back in your second or third year wishing you had understood these options from the outset. It's really about building smart, right from the ground up.